Good
Good
morning
morning, everybody.
and welcome to the City Private Equity Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Fund Manager Hamish Mayer. Good morning to you.
Good morning, everybody, and thank you for joining this presentation on our interim results. It covers the first 6 months of 2024. So I'm going to take you through a presentation which covers the highlights and a little bit of detail, and then we'll open up the discussion for questions. And I'll do my best to answer as many as we have time for. So I've got the slides here. I'll just take you through. So highlights, we basically have seen reasonable growth in NAV in the second quarter of up 2.3%, which gives us a positive number for the first half of the year, up 0.8%. It's quite normal for the movement in NAV to be relatively modest one way or the other in the first half of the year. The valuations, there's a time lag in valuations as usual, and so most of these valuations are essentially March numbers. A small number of them are June ones, probably about 15% are June numbers, 85% March numbers. And the March numbers themselves tend not to change that much from the December NAVs because they are compiled literally a few weeks later. Having said that, I will be able to give you an idea of trends within the portfolio, and you can see what's happening. A couple of things to highlight. First of all, we had realizations of 36.3 million in the second quarter, which is quite a nice increase from the first quarter, and gives us about 53 million or so of realizations in the year to date, which is more than 30% ahead of where we were at the same stage last year. And these realizations, in addition to others that have taken place since the end of June, mean that we've already exceeded the full amount of realizations for 2023, which was over 60 million. So we've seen quite a decent recovery, and I think that's encouraging because realizations tend to be at a nice premium to carrying value, and so strong realizations does tend to correlate ultimately into good growth in NAV. The dividend has been maintained at 7.01 pence, and that will be paid at the end of October. Hasn't gone up because the NAV has not increased sufficiently to bring it up, but hopefully that will happen later in the year. Just to remind you, the dividend is based on 1% of the average of the previous 4 NAVs, and once it's set at that level, even if the NAV growth isn't there, we hold it at the level of the previous dividend. That's what we're doing at the moment, so you will get that dividend in due course. That means the shares are on quite an attractive yield, about 6.5% at the moment, which I think is really good value. The co-investments are now 44% of the portfolio. It's been sort of creeping up. Long-term aim is to get to about 50%, but obviously it's a slight moving feast. Things are being sold all the time, and so we have to keep investing to get it up to that level. But the exits are good drivers of NAV growth. So in terms of new investments in the second quarter, we had a £10 million commitment to August Equity Fund 6. This is a UK lower mid-market buyout fund. We've backed several of their funds. They're all very strong, so a good, strong relationship with them. And we've done one co-investment. This is in a new company called Accounts IQ, which is a software company. It provides software for accounting purposes. And the deal is led by Axiom, who are a new private equity firm who specialize in software and other sort of technology enabled businesses. So a couple of words on some of the recent exits. Now, we sold Jollyes, we got the money in April. This was flagged earlier in the year because we knew it was coming. And this has been a great success. We've made more than 4 times our money in 6 years, a 27% IRR. So Jollyes is a large format pet retailer, so pet shop basically. It's the second largest chain in the UK after Pets at Home, which is the dominant player. This deal was led by Kester Capital, and they took hold of what was essentially an ex-family company that needed a lot of modernization, a lot of professionalization in terms of its management. And they have provided that, and the business has grown substantially. Basically, they have doubled the profitability, and they have nearly doubled the estate of stores. As a retail business, it's obviously had to cope with the pandemic and all that sort of thing during the holding period, cost of living crisis, etc. Fortunately, pet shops were allowed to stay open right the way through the pandemic, and lots of people went off and got dogs and cats, and that has acted to our benefit. The business has been sold to TDR Capital, who actually have a controlling stake in ASDA. So they can see a lot of upside in the business from here, but we've already made 4 times the money, and it's time for us to move on after 6 years. So great success there. We have also exited Coretrax. Now, Coretrax is an energy services company. It does wellbore plug and abandonment services. So what does that mean? And basically, you've got oil rigs out in the North Sea and various other provinces, and when you've finished with an oil well, you have to plug the well. There's various bits of equipment you put on top of the well. This has a degree of counter-cyclicality in it, in that it is a beneficiary of the decommissioning trend that's going on in parts of the North Sea, but it also benefits from new activity. This business has grown quite a bit during the holding period, which is essentially 6 years. They bought a significant business in America called Mohawk, which provided access to the business in the Permian Basin, which is the main sort of oil area in the States. The background has not been that easy for the company because you've had quite a lot of volatility in the oil price, and that has a bearing on levels of activity. But the lead manager here, Buckthorn, who are energy specialists, were able to negotiate a good sale to the large listed company Expro, and we made 1.8 times cost and 12% IRR, which in the circumstances is not a bad outcome. Interestingly, Expro is now a listed company in America, but originally it was actually a British private equity backed company, and we were actually invested in it more than 25 years ago through one of the Candover funds. So it's interesting how things have turned around, and it is now acquiring one of our other businesses. So that was good. We got mixture of cash and shares, and the shares have been essentially largely sold down now. So we've actually got almost all the cash in. There's about £500,000 left in escrow, which will come out eventually. But we're basically out, which is excellent. More recent exit is ATEC. This is also a Kester Capital deal. ATEC is a small insurance company. They basically insure little caravans and small boats, and this has grown quite impressively in the 7 years or so since we invested, grown their gross written premium threefold, from 25 million to 75 million, and significantly increased profitability as well. And that is against a fairly challenging background for the insurance industry. So another excellent outcome. So we're going to make 5 times cost, 28% IRR. In fact, we're actually getting the money today. So that has happened. And that was at a decent premium to the previous carrying value. So that added about 4 million or so to the valuation from this exit alone. So great outcome. Kester Capital have been involved in 2 of these exits. They're an emerging private equity firm that we've backed several years ago now. I was going to say they're young guys from Silverfleet. Well, they're younger than me, but they're maturing now, but they're extremely successful, and very happy to be in partnership with them. And we've done a few co-investments already, and there are others in the portfolio, and we're happy to be partnered with them going forward. So this is the progression of NAV and dividends over the long term. It gradually goes up. Obviously, it's been a little bit quieter in the last year or so, but we are now picking up again. And the long-term picture is that we do tend to go up steadily. And this is the picture over the 25 years. Some of you probably remember we're celebrating our 25th anniversary this year. I've been involved right since the beginning. And over that time period, we have made, for our shareholders, 4 times the gains they could have made if they were just investing in the stock market. This really underlines not just the benefits of investing in our shares, but also the benefits of staying invested in the private equity asset class for a long period of time. You get really powerful compounding returns which deliver returns which are basically unavailable in other asset classes. So this is a good way to play private equity in a safe, diversified fashion. This is just another way of looking at performance over the different time periods and individual years. We've obviously had some really strong years. A couple of years ago, it was less strong last year, but hopefully it's going to accelerate back towards the longer term trend soon. In terms of outstanding commitments, this is the commitments to funds. Now we obviously have to have these in order that we keep redeploying capital back into funds. That's about 206 million, of which about 25 million is to funds where the investment period has expired, and we don't expect much of that 25 million to be drawn. So the level of outstanding commitments is about in line with the 5-year average. It's certainly not too high. People always say, "Oh, what happens if it's all drawn down at once?" Well, it won't be, because it's spread over dozens of different funds, and any individual commitment is relatively small. And even for that to be drawn, it would require a manager to do a whole lot of deals virtually simultaneously, which they just are not capable of doing. So we forecast drawdowns and realizations in quite a lot of detail. We always have done throughout our 25-year life. It's a way of making sure that the balance sheet is used efficiently. This is the debt profile. Currently got debt of about 91 million. That's actually gone down today with the receipt of the money from the ATEC exit. So we're back down into the sort of mid-70s now. And we basically renewed our borrowing facilities in February. So we've got plenty of headroom. Even at 91 million, we have about 40 million of headroom. Excuse me. And we can use that to make new investments. It's likely that debt will decrease a bit from here. It's important to have a decent amount of debt to get the benefits of it. It does enhance shareholder returns, because the long-term return we expect to make from investments is considerably in excess of the cost of debt. Even with a higher rate of interest, that we'd still expect that to be nicely enhancing. Shareholders aren't expecting us to run with piles of cash, a sort of piggy bank approach. I mean, you want us to invest your capital in private equity, and that's what we do. So we try and maximize the efficiency of the balance sheet. The portfolio we have is a good portfolio against which to borrow because it's very well diversified and it's got lots of good quality companies in it, and the banks therefore are very comfortable lending. In terms of new investments in this year to date, just to recap, we did the Agilitas Human Investment Fund earlier in the year. Agilitas, we've backed them many times before, both through funds and co-investments. They've got a strong track record. We also backed Corin Environmental Fund. This is a fund focusing on clean energy, and it is run by Gary Lasser, who used to be at Scottish Equity Partners, where he ran the Environmental Energies Fund, which was a big success. And so we've backed him in this new fund. We've also backed MedRise. This is a healthcare fund run by Archimed, who are a French-based life sciences investor who are very successful, and we've had a number of good deals from them. August Equity, I mentioned a minute ago. This is us backing the latest in a series of August Equity mid-market funds, all of which have been pretty strong. And then lastly, we've done Accounts IQ, which is the new software investment, which I'll talk about in more detail in a second. Just a couple of a few slides on recent co-investments. I won't talk through these in elaborate detail, but just touch on the high points to give you an idea of the kind of things that are in our portfolio. These are co-investments done in the course of the last 12 months or so. So this is Cyclomedia. So this company basically maps built up areas, produces these maps principally for the use of local authorities who use them for the purposes of local taxation. That little car there has a sort of LiDAR system on the roof, and it basically scans all these properties, and you can get very detailed maps produced. And the business started in the Netherlands. It's pushed out into Germany, into the US as well. Volpe, who are the lead on this, have been in the deal for over 5 years, and therefore they know it inside out, and they're having a second shot at it, and they brought us in as a co-investor. So we've got very high visibility of the business we're buying and the strength of the proposition. So we're optimistic that we'll make a good return over the next 3 or 4 years. Next one is Utamaco, which we went into last year. This is a cybersecurity company. They make special sort of tamper-proof tokens, and for a range of industries. They have between about 5 and 10% market share already. That market is growing rapidly. It's growing in sort of double digits, and their share is growing into that growing market. So this business has got off to a really good start. So it's up already after a year. So hopefully make about 3.5 times our money over 3 years or so, which would be great. Next one is BrainCube. This is a software company that provides software to improve the efficiency of manufacturing processes across quite a wide range of sectors. It allows them the companies to refine their systems, their process, to reduce costs, reduce energy, maximize productivity. Already has a really interesting range of customers. SEP generally invest in the UK, but they do invest outside the UK. So this is in France, actually. It's in Issoire, which is in central France. And again, this is a growing market, and where they already have decent market share. So they should be taken on quite a bit further with the help of Scottish Equity Partners. Educa EdTech is a deal led by the Spanish firm Orica, and we've been tracking Orica for a while. This basically is an online education company. So they essentially run university courses for people largely in the Spanish-speaking world. It started in Spain, pushed into Latin America, quite high growth sector, and we managed to get in at a relatively low price. 8.3 times EBITDA is low for this type of business. So we're optimistic about how that will go. And then we've got Accounts IQ, which is the new co-investment I mentioned earlier. So this is accounting software, software as a service. It is for sort of medium-sized companies. It's a more modern solution than some of the sort of Sage type things that people typically have or companies typically have, and it fits in quite quickly. It's quite easy to install. So Axiom are the lead here. They specialize in software and technology-enabled companies. And this is one of their first deals, and they brought us in as a co-investor alongside the fund. The Axiom guys are pretty experienced. You know, they're quite young, but sort of driven, classic emerging managers, the sort of people that we like to back. We know some of them from their previous firms, which is important. Gives you confidence in what they can achieve. So I hope to make about 3 times the money on this one. So quite a few realizations in 2024 to date. You can see the numbers on the right-hand side. It's very attractive multiples of cost and good, you know, nicely positive IRRs. I mean, anything above about 25% IRR is a pretty good outcome, and most of these are comfortably above that. You know, this has continued on. It's actually picked up quite nicely in the second quarter, as I mentioned earlier. And also we're making new investments, so plenty of drawdowns. These are across a range of different geographies. You can see that in the UK and different European countries, and also some in North America, different lead managers. So you're getting all this diversification by, you know, sector, geography, lead manager. And as a lot of you probably heard me mention before, diversification is absolutely critical. It's the only practical way of reducing the naturally high risk involved in private equity down to moderate levels. And so this diversification is renewed constantly as the funds in our portfolio draw down. This is distributions and drawdowns, longer term trend. It's just there for information. There's obviously you know, there is a close correlation between distributions and drawdowns. You know, when one side picks up, the other side tends to pick up as well. And looking at the largest underlying holdings, I mean, some of these have now been sold. ATEC obviously has been sold, so has Coretrax. The others, none of these are immediately about to exit. I mean, Sigma and TWMA have got exit plans. Probably won't be achieved by the end of the year, but maybe not that much later. And some of the others are earlier in the holding period. Aurora, which is a payments system, digital payments provider in the States, has got a couple more years at least to run. Weirdfish has got a new chief executive who's doing a good job, but he needs a bit longer to be able to maximize value there. And Contained Air Solutions, which is the fume cabinet manufacturer, has just done a couple of significant add-on acquisitions which need time to integrate, so that will be another couple of years as well. And then Cyclomedia and Newtomaco are still, you know, these are new deals, have only been in them for a year, so there'll be another 2 to 3 years holds there. But these businesses are all in pretty good shape. Hoffy, that's what we used to call San Siro. This is the second leg, if you like, of our funeral services company in Italy, where we'd already made sort of 8 times our money. We've held on to 25% of the original investment in the sort of second stage of that. So we're optimistic that that will go well. But we'll need to be in it for another year or two. In terms of the spread of the portfolio, geography, 42% in the UK. The UK is always our largest market. It's our home market. It's the biggest private equity market in Europe, and it's quite, it's a deep market. Most of the rest of the money is invested in continental Europe, although we have about 17% in the States. We always have had a bit in the States. That's the biggest and deepest private equity market globally, and we have got some good links there, so we will maintain that representation. The portfolio has always got a maturing element that's coming through, and this fuels the realizations. I mean, half the portfolio is more than 4 years old, which is, the typical investment thesis for one of these companies is normally a 4 or 5 year, is based around a 4 or 5 year hold. And so when they're in the third or fourth year, this is, they start to turn their minds towards exits and start planning. And we always have realizations coming through. I mean, it fluctuates a bit in volume, but we don't have completely dry patches at all. We always have some things coming through, and that does drive growth in NAV. The portfolio is not particularly highly valued. In fact, it's actually quite inexpensive compared to most of our peers. The weighted average EV to EBITDA, enterprise value essentially to cash flow, is 11 times. That's down a little bit over the course of the last 12 months. And the weighted average entry price, the price at which these companies were bought, on average is 8.7 times. So they've been re-rated a bit as the holdings have matured, which is kind of what you'd expect. It's not very highly geared. Debt to EBITDA is 3.1 times. I mean, that's been about that level for some time. So yes, there is gearing here. I mean, they are largely management buyouts, which are based around using a combination of equity and debt to buy the businesses, but the gearing is not high. In terms of sectoral split, we've got significant exposures to healthcare and information technology. Now, these are both sectors displaying very robust long-term growth. They're also quite large, broad sectors. So, that includes information technology, includes software and services as well as hardware, but it's mainly software. Healthcare includes, everything from sort of drug discovery through to care companies, through to, contract research organizations and medical devices companies, all sorts of different things there, most of which have got quite an exciting story to tell. So just to conclude, the portfolio is very resilient. As growth in NAV has started in the first half of this year, pretty confident we'll see good growth in the second half. As I mentioned, we have got new borrowing facilities in place, which give us plenty of headroom and firepower, allows us to nicely gear the portfolio and enhance returns for shareholders. There's plenty of opportunities to invest into new deals, co-investments and funds. Quite often you find after there's been a bit of an economic slowdown, it's actually a very good time to invest. So we see, literally hundreds of opportunities, and we will take a few of them, carefully. We are seeing encouraging signs of recovery in M&A, a clear improvement in the second quarter, and that seems to have continued into this current quarter. The uplift on exits in 2024 to date is 35% above previous carrying value. So that compares to 29% in 2023 and 36% in 2022. So that's a pretty healthy number, and that bodes well for NAV growth. Plenty of people want to invest into private equity. Fundraising for private equity has been tougher this year, but there's a lot of so-called dry powder, lots of capital that's just been waiting to be deployed, and we can see that being spent over the next few years. And so, we're confident looking forward. We think we'll grow shareholder value the remainder of this year and well beyond that, and keep up the long-term record of impressive growth. So that's the end of the formal bit of the presentation. So I'm happy to take some questions now.
Great, thanks, Hamish. Hopefully everyone can hear me. And I'll first go through just the pre-submitted questions, but obviously we'd be delighted if more people can submit more as they've heard the slides and heard Hamish's points. But yeah, there are some interesting ones which you have alluded to in some respect. But the first one is related to the AGM presentation. You showed NAV growth of 2.8% for the fiscal year, but you also show revenues and EBITDA of the underlying portfolio companies grew by 17 and 29% respectively. Shouldn't the NAV growth be closer to the EBITDA growth? And does the discrepancy mean that multiples contracted?
Yes, I mean, growth in EBITDA is not the same as growth in earnings per share, but if you're getting good growth in EBITDA, you would expect there to be, healthy growth in NAV. I mean, there are a couple of things to be aware of. The valuation multiple did go down actually over 2023. It went from 11.6 times down to 11 times. So, the profits growth was not going to be fully reflected in NAV when the multiples are going down. So that does happen from time to time. And then you've also got other things like interest costs gone up. You also pay down debt repayment, which means it isn't a simple relationship between EBITDA growth and NAV growth, but it's basically you're not going to get NAV growth unless you've got decent growth in EBITDA, but it's not as mechanistic a relationship as you would get if you were looking at earnings per share growth, which isn't really a statistic that you can derive from a private equity portfolio. So that's that one.
Apologies. Yes, thank you. That makes sense. Now onto undrawn commitments, which are around 40% of net assets in line with 5-year averages. But shouldn't this ratio decline with increasing proportion of the portfolio invested in co-investments?
Not necessarily. I mean, we are gradually increasing the proportion in co-investments, up to about 50%. And our outstanding undrawn commitments are roughly 200 million. 50% of the portfolio is essentially 250 million. These commitments are drawn down over 4 or 5 years. So we do have to keep it at a reasonable level in order to keep redeploying back into funds and not start sort of having an inefficient balance sheet piling up cash. So we monitor the level of commitments because we have covenants and things that we have to keep an eye on. We obviously don't want to get it into such a kind of high number that it frightens people. It's nowhere near that level at the moment. So I mean, this it's likely to be at or around this level or slightly higher for the foreseeable future.
Okay. Then there's also a pre-submitted question about Utimaco, and they're referencing a recent presentation where you stated you were able to invest 18 months after the deal was agreed, effectively reducing the entry multiple.
Yeah.
And they just want to know, how does that work, and why would you be able to participate in the deal 18 months later?
Yeah, that's because the general partner was keen for us to come in as a co-investor. I mean, the position that they held was probably larger than they were comfortable holding, just because of the size of their fund. This type of thing does happen. So the general partner is essentially warehousing the deal for, in this case, 18 months. During that period, the profits have grown. And they bring us in at the original cost price. So it means we're getting in at a lower multiple than they went in on. But it makes sense for them because they needed to sell down part of it because it was above their natural holding size. This situation does occur from time to time, but it's quite rare. I mean, it's a good situation. It's one of the inefficiencies that you sometimes find in the private equity market, which act in our favor, and it gives you a really good start for the investment. And if an investment starts well, that is a big part of its long-term success.
Yeah, that's interesting. Related to the primary commitments in Q1, and it stated that they were all to funds that range between 100 to 375 million in size. And the comment is those fund sizes sound quite small. Is this representative for the whole portfolio? What's the average fund size that you invest in or with?
Yeah, so I mean, maybe it sounds small, but a 375 million pound fund isn't really a small fund. I mean, obviously, if you read the FT and it's all about Blackstone raising billions and billions, you might think they're small, but these are decent sized funds. I mean, we're a mid-market specialist, so we're typically investing in funds that are between 100 and 500 million pounds or euros in scale. We will occasionally be in funds that are bigger than that, might be over 1 billion, but that is the exception. They're very well rehearsed arguments in favor of the mid-market. You grow more rapidly from a smaller base. The mid-market generally offers companies on lower entry prices, which, there's an inverse correlation between entry price and return, unsurprisingly. And there are lots of interesting pure plays across the continent of Europe and further afield, lots of really interesting businesses which have got strong growth. We're getting involved earlier in the growth story. These companies are of a size where they have got good quality management, focused management, who've been carefully selected by private equity. And so the fund size is a function of our mid-market focus. We're not doing sort of tiny little deals. The average size of a company that goes into our portfolio is an enterprise value of around about 100 million pounds. So, it's not the corner shop. I mean, it's a decent sized business. It's probably got, 10 or 12 million of profits. They're generally a bit on the small side to go to the stock market. But sometimes they will exit to the stock market. More often, they will exit to being sold to bigger private equity funds. So we like there to be big funds around, but we're not going to back them. We sell to them rather than invest with them.
Great. Moving on to dividends, there's been a few people ask about it. I think David and Andrew, just to name a few. They're asking essentially, is the dividend level sustainable? They reference the AIC Next Generation status of dividend hero, meaning that you've passed 10 years of consecutive growth in dividend, but to reach a full dividend hero, you would have to provide 20 years of consecutive growth. So they're just asking, how sustainable is the dividend? Are you looking at a 13th year of growth?
Yep, the dividend is set at a level that we are confident is sustainable, and we're also perfectly well aware of our dividend hero status and don't want to lose it. So it is likely that we will have an increase in the 13th year, and hopefully every year thereafter, because the dividend it does have these flat periods, but it does basically track the growth in NAV. So as long as the company's growing, the dividend should be growing.
Yeah, exactly. It's that formulaic approach. So it is very much determined by the NAV, but it is struck at a level that it will not fall from. At least that's the commitment by the board currently.
Yeah.
Then moving on to the discounts, because that's coming up a bit. Andrew's asking, what is your feeling on the trust discount to NAV in the sector, and how are these evolving? It still looks a bit wide, and it kind of tying in with another theme that's coming through in the questions about interest rates. Do you feel like now, for example, with a change of interest rate environment, that might help boost the discount, the share price?
Well, I mean, discount, we think sort of is uncomfortably wide, and basically we have to try and encourage as many people as possible to buy the shares to tighten that discount, bring it in, ultimately get to a premium. The valuation methodology is naturally conservative. We can see that the realizations are typically at 30% plus premium to immediate carrying value, and there have been lots and lots of realizations over the years. So it's very much proven that there's nothing wrong with the valuation methodology. So the discounts in our sector tend to be a function of the general attitude in the market towards risk. So when the market is in a kind of risk on frame of mind, the discounts tend to contract, and when they're in a risk off frame of mind, they tend to widen out a bit, and they've widened out a bit recently. I mean, over the long term, it provides a brilliant opportunity for people to buy in, basically buying the portfolio at 2/3 of its actual value. And, that value is likely to grow as it realizes over time and as the underlying companies grow. There's no sort of easy answer to reducing the discount. Some people think, well, why don't we buy back loads of shares? That will help. Well, it doesn't necessarily provide a permanent solution. In fact, there's little evidence that it does do. It does enhance NAV a little bit, but there's a limit to how much you can buy back without, diverting a lot of your precious capital away from new investments or from paying the dividend or paying the interest or whatever. So that all has to be weighed up carefully, which is what we do. But the best way of narrowing the discount is to build the demand for the shares. So me doing presentations like this and going around and seeing people all around the country and everywhere else and persuading them that this is a really good vehicle to give you exposure to a strong performing asset class, which will deliver superb returns for you over the long term. So I've just got to get that message across, accompanied by all our different salespeople and our brokers and everybody else. There's no easy solution to discounts. It is likely the discounts are likely to get significantly narrower because we're now going into a better environment, as you can tell from my statement.
Yeah. Maybe just
a question about interest rates as well, whether that's
yeah.
going to make a difference into long-term returns. So interest rates have been, for 15 years until a couple of years ago, were at abnormally low levels. We were always expecting it to return to more normal levels, which we're at now. The private equity investors are generally, experienced people. They always thought that they were going to see higher, more realistic rates of interest, and when they do deals, they very much had in mind that there would be a reversion to normal rates of interest, and that has now actually happened. I mean, the immediate effect of it is it will push, or it has pushed down prices a bit, and we've seen some of that adjustment. But that throws up good opportunities for investment, and the adjustment does tend to be gradual. So it's perfectly feasible to continue to make strong returns. I mean, the private equity required return, I made my first private equity investments in the early 1990s. I read the investment papers. They will say, our target return is 36%. And, this is papers I was reading in the early 1990s. The papers I read now, they say our target return is 36% and have done all the way through, or whatever, 30-something%. So it's an absolute return asset class. So they are looking to make those sort of returns, and there's a price that they will have to pay in order to make those returns. When interest rates go up, that price will go down a bit, and then they'll invest at that lower price. And if everything goes according to plan, they will make those returns. Now, obviously, it doesn't always go according to plan for every single investment. Otherwise, our NAV growth would be 30-something% over 25 years. Per annum, and nobody achieves that. But it is feasible to achieve a return in the mid-teens or better, and the best funds do achieve that, and we are in that category. So I think interest rates having gone up is something that we have to adapt to. Obviously, these are management buyouts. Half the capital structure is debt, so the cost of capital will have gone up, and therefore the acceptable entry price, all things being equal, which they never are, will have gone down a bit. And but there will be plenty of dealing at that new level.
Yeah, that's very interesting and good food for thought. Maybe touching on Rosita's question, sorry if there's background noise, what would be your wish list from the budget? Have you heard anything yet that makes you hopeful? So maybe commenting on the UK politics.
Yeah, so I think a lot of you who follow this will see that the Labour Party have been threatening to increase the taxation on carried interest in private equity. And if they moved it from the current rate, which is 28%, up to the full income tax rate, which in our case in Scotland is 48%, it's 45% in the rest of the UK, but we have the privilege in Scotland of paying extra tax. That would be disastrous. I mean, if they increased it from 28 to 48%, it's quite likely they'll increase it by a smaller amount. They're in the so-called consultation phase at the moment. So me and many others in the sector are saying to them, this is actually going to be quite damaging to the sector if you do, if the worst case scenario unfolds. Similarly, if they put up capital gains tax significantly, that will act as a brake on enterprising activity. I mean, there aren't very many people pay capital gains tax, but the people that do are the people that tend to be driving the economy forward. So I think if the government are serious about being pro-growth, pro-enterprise, they need to, not introduce measures that actually blunt enterprise and therefore blunt growth. So we would hope that some of the worst case things that have been trailed don't actually happen. That would be a win for us because there's a lot of concern in the sector.
Okay, fingers crossed. Maybe another different angle now. David's asking, what benefit does the trust get from being managed by the CT group? Maybe I can even just comment from the sales, marketing, and other ancillary services. It's part of such a vast corporation that has that economies of scale. First and foremost, you get highly experienced and talented people, obviously not referring to myself there, but in company secretary services, marketing, press relations as well, and then that ability to negotiate with third parties on other services and marketing opportunities. As Hamish mentioned earlier, just trying to get the message out there as much as possible. So being part of a range of 9 investment trusts where we have around £10 billion worth of assets under management, it makes us a very attractive partner for various other entities to work with us, and then that gives CT Private Equity Trust another platform with which they would be able to voice their message to a broader audience. But I'll hand over to Hamish more from the investment perspective.
Yeah, I mean, we're a relatively self-contained autonomous unit within Columbia Threadneedle Investments, but we do benefit from being within the larger group because all the ancillary functions and support functions, including distribution and marketing, are provided for us, so we can concentrate on basically investing money and in raising money. We actually have to do a lot of the fundraising ourselves because it's quite a specialized activity. And ultimately, we should get access to the wider Ameriprise network and channels. So, I mean, that takes time to come through. We discuss it with our bosses in America on a regular basis. And, eventually we will be able to expand our client base into the wider Ameriprise network and channels. So, that's a big thing. We have, we've good contacts in America already, but these are supplemented by people that we introduced to by our colleagues over there. It's a pretty sort of benign relationship. I mean, obviously, all big financial institutions, come with a certain amount of, bureaucracy, and we had that before in the Bank of Montreal and to some extent within F&C. But you get benefits from that bureaucracy. You have good processes, systems, rigor. Things that shareholders can take confidence in. There's a lot of sort of checks and balances in these systems. But I mean, the key thing is that we retain the autonomy that we need to make money for our shareholders.
Yep. Mike has asked a question on the topic of gearing. So could you please clarify the gearing of the trust versus the exposure the trust has to its underlying investments burdened by debt? So I suppose just commenting on the gearing in the context of the wider portfolio's leverage through the underlying.
Yeah, so I mean, the company is currently geared about 15%, and it's going down a bit, which is within its kind of normal range. The underlying businesses are about 30% geared. 30% of their enterprise value is debt. Bit less actually, 25%, which is not particularly high. So these are management buyouts, so they do have debt on their capital structure. It's one of the ways we can make strong returns, but we're not particularly highly geared, or we're not immune to higher interest rates, but it's not at a threatening level. Far from it. I'm just looking at some of the questions. Somebody's asking if we've got any venture capital type investments
Yeah, I was going to
in
ask that
profitable
next.
companies. It's about 4% of the overall portfolio, so it's a small amount. We've always had a little bit, but we are mainly mid-market buyouts. There's another question about buying back shares. Well, we bought back 1.7% of our share capital in the first half of the year, which is more than most people have done. And we will weigh up the merits of buying back shares versus using the capital for new investments or paying dividends or paying down debt or whatever. I mean, it's not a straightforward equation of saying, well, if you to buy back the shares now, you make an immediate, handsome and certain return. Because if you do too much buying back, you will actually end up over gearing the company. And although you might have enhanced the NAV, you're unlikely to enhance the share price. As I said earlier, there's no magic bullet to getting the discount down, and you cannot just do it by buying back lots of your shares. It doesn't work. I mean, Pantheon have tried it; hasn't made much difference. Incidentally, they had not actually paid a dividend at all. We have distributed a lot of capital to, I think it's about 136 million over the last 10 years to shareholders via dividend. That is one of the reasons where typically our discount has been narrower than our peer group, and I expect to get back to that better rating than the peer group quite soon.
And do you have time for one or two more?
Yes.
Literally, I think
Yeah.
there's just a couple more there. Maybe Jens's question about the manager-led secondaries, and do you see opportunities there at the moment?
Yeah, we do invest in some of these. Yeah. We do see some of these. I mean, not that many of them, but that we do. But I mean, we appraise them in the way that would appraise any co-investment or secondary. I mean, we will not deal in a co-investment or a secondary unless we're sure we can do a 25% net IRR, which is quite a high hurdle. So a lot of things will fall down at that stage in the analysis when we look at the returns. But yes, we will do some of these.
And then maybe lastly, before summarise with some closing remarks. Do you have a view on the university spin-outs in the UK, and do you get involved in those at all?
Interesting question. I happen to chair the university spin-out fund of Edinburgh University, which is called Old College Capital. So I do know about this. Now, most of these businesses are at too early stage to be included in this portfolio, but it is a very interesting sector. There's going to be some great successes. I mean, our Edinburgh portfolio is there's 30 something companies. We've already had one big exit, made about 7 times our money on that, and there's several others that will come through. It is quite risky activity, and basically venture capital is a difficult place to make money generally. We favour mid-market buyouts because the returns are generally better and it's lower risk. It doesn't mean that we would never do any venture capital, but we wouldn't probably do any of this sort of seed stage activity, which is what university spinouts tend to be. Having said that, we do have a position in Northern Gritstone, which does university spinouts from the universities of Manchester, Sheffield, and Leeds. And the manager there of that fund is somebody we've known for a long period of time, so we're pretty confident that they can do that well. It's a really interesting sector, university spinouts. There aren't that many universities that have done it successfully, but Edinburgh is one of them. Unfortunately, members of the public can't get access to that yet because we don't have a vehicle that is available. Who knows? We might have one in the future.
Okay, thanks so much for answering all these questions. Do you want to just say a few closing remarks?
Yes, look, I think we've had a good start to the year. I think the market is clearly showing some signs of improvement. I mean, things are not booming yet, but they have definitely improved. We are seeing plenty of new good investments, places to deploy our capital, and we are also now seeing the flow of realizations picking up nicely, and these are closely correlated with growth in NAV. So looking forward, we've still got a large part of the year to run. We can't have complete visibility on how things are going to pan out, but we do have confidence that we will be able to, grow the NAV between now and the end of the year. So I think there's been a lot of focus on the discount. The discount provides a brilliant buying opportunity, and I would encourage those of you who are interested and have the capital to take that opportunity whilst it exists. Thank you very much for your attention, and hopefully I've answered most of those questions. And
Fantastic.
Thanks again for joining.
Fantastic. Hamish, Christine, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CT Private Equity Trust PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.